You were never supposed to see inside the Federal Reserve's balance sheet. Not really, and you certainly weren't meant to understand the complex flows of money moving beneath it. Why? Because the real story of our economy isn't found in the splashy headlines or the carefully worded interest rate announcements. No, the real story is hidden in plain sight, buried in the weekly H. 4.1 releases those dense tables of numbers that almost everyone ignores. These are the numbers that quietly reveal when the entire global funding system is starting to shake. Most people believe the Fed steers the economy simply by raising or lowering interest rates. It's a simple, comforting idea. But if you've ever spent long nights staring at liquidity screens, watching the digital rivers of money flow, you know, the truth is a lot more complex, and frankly, a bit darker. Markets don't just move on their own. They are moved. And the Fed's balance sheet is where you can find the fingerprints of the movers. Think of it as a forbidden flow, a hidden river of collateral, bank reserves, and international swap lines that acts like the financial system's nervous system. It sends out warning signals long before the rest of the world even senses that something is wrong. This isn't just a theory, it's a pattern. Let's go back to 2008. The first cracks in the system appeared right here, on the balance sheet, months before Lehman Brothers collapsed and sent shockwaves around the globe. Fast forward to 2019. The repo market crisis, where overnight lending rates skyrocketed, wasn't a surprise if you were watching the balance sheet. The signs were there. And then, in 2020, the massive funding panic that preceded the global lockdowns. It was written, clear as day, in the Fed's assets and liabilities before most people even knew what was coming. Even now, as we speak, this hidden layer of the financial world is making critical decisions. It determines which banks and financial institutions get the liquidity they need to breathe, and which ones are quietly left to suffocate. It's a powerful, silent force operating behind the scenes. Every time the Fed makes a public decision about interest rates, there's a much more important story unfolding beneath the surface. It's about the assets the Fed holds. Are Treasury bills moving in or out? Are repurchase agreements, or repos, suddenly swelling for reasons no press briefing ever mentions? Is the discount window the Fed's emergency lending facility blinking like a warning light on a dashboard? Are swap lines, which are like emergency credit lines to other countries' central banks, being extended like financial arteries across continents? These aren't just academic details. They are the vital signs of the global dollar system. Every single time liquidity tightens around the world, every time high-quality collateral becomes scarce, every time the offshore demand for U.S. dollars overwhelms the available supply, the truth shows up here first. It appears on the balance sheet long before the financial news channels even begin to craft a narrative to explain it to the public. And here's the most unsettling part. You don't need a full-blown crisis for these flows to be incredibly meaningful. Small imbalances, tiny rotations between different types of assets, minor contractions inside obscure line items like the foreign official repo pool or other credit extensions can signal immense structural stress building up just beneath that trillion-dollar facade of stability. What the public sees is a central bank calmly adjusting a single interest rate. What the financial system actually experiences is a massive balance sheet absorbing shocks, stabilizing markets, and making choices at the precise moment something, somewhere in the world, breaks. This is why the story is so crucial. The real secret isn't how much money the Fed prints. Everyone talks about that. The real secret is where inside its massive balance sheet the Fed decides to shift its weight. What kind of collateral does it choose to accept and support? Which specific markets does it quietly bail out before the public even hears a whisper of trouble? These hidden moves create winners and losers long before a crisis makes it obvious to everyone. One institution gets a lifeline, another doesn't. One market is propped up, another is allowed to fall. And it all happens through the silent, technical adjustments on a spreadsheet few people understand. Think about every major market shock you remember. The 2008 financial crisis, the 2019 repo panic, the 2020 liquidity crisis. They all started as faint tremors on the Fed's balance sheet. They were forbidden signals, buried in plain sight for anyone who knew where to look. And if you follow those same flows today, you start to see a familiar pattern forming all over again. There's a silent pressure building in the system. Collateral mismatches are widening, strains in offshore dollar funding are reappearing, and the Fed is adjusting its balance sheet in ways that don't quite line up with the official story we're being told. The narratives about inflation and employment are just the surface layer. The real action is in the plumbing. This brings us to the stories you might hear about trillions of dollars missing or unaccounted for. It's not about a grand conspiracy or some cartoonish villain hiding stacks of cash. The story of missing money doesn't begin with fraud. It begins with the plumbing of the financial system. Because in a modern liquidity system, money, especially at this scale, rarely disappears. It simply moves. It flows into the hidden corners and obscure channels where you were never, ever supposed to look. You think you know what the Federal Reserve does? Manage inflation, keep people employed, stabilize the economy? That's the official story, the one we've been told since its creation in 1913. But the real story is hidden deep inside its balance sheet, a ledger so complex that trillions of dollars can seem to appear and disappear without a trace. This isn't a story about domestic monetary policy. It's the story of the dollar's secret second life, a global financial architecture that the Fed doesn't control, but is forced to rescue, time and time again. To understand this, we have to forget Washington, D.C. for a moment and travel back to the 1950s, to the birth of the eurodollar market. After World War II, America flooded the world with dollars. They rebuilt Europe and Japan, fueled global trade, and became the currency of oil. But something strange happened. Banks outside the U.S., in London, Tokyo, and beyond, started taking these dollars and creating their own dollar-based loans, deposits, and derivatives. This was the offshore dollar system, shadow network operating beyond the Fed's direct reach. It grew so massive that, by the end of the 20th century, the amount of these synthetic, offshore dollars dwarfed the physical dollars printed by the U.S. government. This created a hidden dependency. The Fed's balance sheet quietly morphed from a tool of domestic policy into the ultimate emergency backstop for this vast, unregulated global dollar machine. The first real tremors hit in the 1980s during the Latin American debt crisis. U.S. banks were on the hook for billions in offshore dollar loans gone bad. The public didn't see it, but the Fed had to intervene, tweaking its balance sheet, opening swap lines, and adjusting reserves to prevent a meltdown. The warning signs were there, buried in obscure data. Then came 1998. The hedge fund long-term capital management, leveraged to the breaking point on hidden dollar bets, nearly collapsed the entire financial system. The Fed didn't bail them out directly, but it coordinated a rescue. And in the weeks that followed, the balance sheet told the story. Repo operations spiked, reserve balances shifted. These were the technical, almost invisible signals that the offshore dollar system was dangerously fragile, but the real party was just getting started. In the early 2000s, this offshore leverage exploded, this time hidden inside mortgage-backed securities and complex derivatives. Banks were turning risky loans into supposedly safe AAA-rated assets, creating new forms of money built on a house of cards. They looked like money, they spent like money, but they weren't. The Fed's balance sheet was already picking up the early warning signs. Repo operations were climbing, cross-border dollar flows were getting weird, and obscure line items like other assets were growing. Analysts ignored it. The biggest signal came in 2007, a full year before the world woke up to the crisis. The Fed's balance sheet was flashing red. The foreign repo pool surged, discount window lending a sign of bank distress popped up, and swap lines with foreign central banks expanded without explanation. While the news was still talking about a contained subprime problem, the global financial plumbing was screaming that the system was breaking. When Lehman Brothers fell in September 2008, the world saw chaos. But for those watching the Fed's balance sheet, the collapse was the predictable finale to a story that had been unfolding for months. Suddenly, the Fed's job wasn't just to be the lender of last resort for American banks. It had to be the lender of last resort for the entire planet. Swap lines, which provide dollars to foreign central banks, skyrocketed from a few billion to over $500 billion. Emergency lending facilities exploded. The Fed started buying up trillions in mortgage-backed securities and government bonds. This wasn't just money printing to stimulate the economy, as most people thought. This was a desperate emergency operation. The offshore eurodollar system had frozen solid, and the Fed was frantically pumping onshore liquidity into the system to replace the money that had vanished and prevent a complete global depression. This is what quantitative easing, or QE, was really about, a global bailout. But even during this massive intervention, strange things kept happening inside the balance sheet. There were bizarre discrepancies between reserve balances and collateral flows. Custodial accounts for foreign governments swelled and shrank mysteriously. Temporary lending facilities would appear for a few weeks and then vanish without a public word. These weren't accounting errors. This was the system reorganizing itself. Money wasn't missing. It was being reclassified, redirected, or canceled out by other hidden contractions in the global funding network. As the U.S. economy slowly recovered in the 2010s, the offshore dollar system did not. It remained broken. European banks, Japanese firms, and emerging markets were still drowning in fragile dollar debts, constantly rolling over short-term loans to stay afloat. The global dollar shortage never really went away. It just got quieter. And once again, the Fed's balance sheet was the only reliable guide. Repo market activity was jumpy and unpredictable. Swap lines remained active, a sign of recurring stress. And the Fed's own Treasury holdings moved in ways that no economic model could explain. It was acting as the silent stabilizer for a chronically unstable world. One of the most dramatic moments came in 2014. Oil prices crashed. This wasn't just a commodity story, it was a collateral story. Oil-producing nations had built their economies on dollar-denominated debt, using future oil revenue as collateral. When the price collapsed, their flow of dollars collapsed with it, threatening to set off another wave of defaults. The mainstream news missed it, but the Fed's balance sheet registered the shockwave instantly. Foreign official deposits at the Fed dropped. Custodial holdings shifted as countries moved assets. And demand for safe U.S. Treasuries surged as the world scrambled for good collateral. The plumbing was screaming again. Then came 2019, the modern warning shot. A seemingly normal September morning suddenly turned into a full-blown liquidity shock. Repo rates, the overnight lending rates for banks, spiked to nearly 10%. Everyone was caught off guard, except for those who had been watching the quiet signals coming from the Fed's own balance sheet. For months, the data had been showing growing strain. Bank reserves were declining, Treasury issuance was rising, and funding mismatches were widening. When the repo market finally snapped, the Fed stepped in instantly. They flooded the markets with overnight and term repos to calm things down. But underneath these emergency interventions, something deeper and more peculiar was happening. The balance sheet recorded strange expansions that didn't quite line up with the official explanations. Temporary lending facilities seemed to create room for adjustments that were far too large to be explained by domestic repo operations alone. Some sharp analysts started noticing what looked like missing entries. These weren't literally lost numbers, but they were functionally untraceable without painstakingly cross-referencing foreign liabilities, custodial account shifts, and the subtle movements of offshore dollar demand. This was the true beginning of the $2.3 trillion riddle. It wasn't a single missing chunk of money, but a persistent pattern of imbalances that revealed serious stress building up far outside the Fed's direct control. Then, when the pandemic hit in early 2020, the Fed's balance sheet didn't just expand, it erupted. Within a matter of weeks, it grew by trillions of dollars. Swap lines, which allow foreign central banks to borrow dollars, soared to record highs. Emergency facilities from the 2008 crisis, like the primary dealer credit facility and the money market mutual fund liquidity facility, were brought back to life. But beneath this flood of numbers, something else was happening. The very structure of the balance sheet was changing in strange ways. Certain line items would mysteriously shrink while others exploded. Global demand for U.S. Treasuries first surged, then collapsed. Custodial accounts, which hold assets for foreign entities, flipped erratically. Foreign repo usage oscillated violently. Even as the Fed insisted it had everything under control, the flows beneath the surface told a completely different story. It was a story of extreme fragility, a dangerous dependency on offshore dollar markets, and deep structural stresses that had never been resolved, even after the last financial crisis. By the mid-2020s, the Fed began its campaign of quantitative tightening, or QT, attempting to reverse the massive expansion of its balance sheet. But QT didn't shrink the balance sheet the way the textbook said it should. Yes, some liquidity disappeared from the system as intended, but a lot of it just seemed to relocate. It moved into foreign accounts, into the Fed's reverse repo facility, into private credit channels, and deep into the unregulated shadow banking system. The $2.3 trillion discrepancy didn't show up as a single, glaring accounting error. Instead, it appeared as a structural mismatch between the reserves the Fed was officially removing and the liquidity that continued to circulate elsewhere in the global financial system. The offshore dollar world had become so vast, so interconnected, and so synthetic that a simple contraction on the Fed's balance sheet didn't reduce global liquidity uniformly. This, in turn, created unexplained fluctuations inside balance sheet categories that were supposed to be stable and predictable. And this is where history becomes our most valuable guide. Every major funding crisis of the last century created distortions that first showed up inside the Fed's accounts, long before the public ever saw them coming. Today, that history is repeating itself. The stress in the offshore dollar system has returned. U.S. Treasury issuance has accelerated to fund growing deficits. Collateral shortages are quietly spreading through the system, making it harder for institutions to secure funding. And once again, Japanese institutions, major European banks, and entire emerging markets are relying heavily on swap lines and repo facilities just to maintain their dollar liquidity. And inside the Fed's balance sheet, the same forbidden signals are appearing. We're seeing odd increases in a line item called other assets. We're seeing sudden, unexplained jumps in foreign repo usage. We're seeing glaring inconsistencies between official reserve levels and real-world funding flows. And we're seeing unexplained shifts in line items tied directly to cross-border liquidity. These are not accidents. They are not clerical errors. They are the echoes of every single crisis since the eurodollar market was born decades ago. The global dollar machine is showing signs of serious strain, and the Fed's balance sheet is quietly absorbing the tremors. So, what is this $2.3 trillion? It isn't a conspiracy, and it isn't a mistake. It is the modern culmination of more than 70 years of offshore dollar evolution. It represents money created outside the U.S. banking system, debts issued in dollars but funded by global investors, complex collateral chains stretched across continents, and mountains of synthetic liquidity built on incredibly fragile assumptions. When these intricate systems come under stress, the flows inside the Fed's balance sheet tell the story long before the newspapers do. The historical pattern is unmistakable. First, the imbalances appear. Then, offshore liquidity weakens. Next, collateral chains begin to fracture. And finally, the Fed adjusts silently, deliberately, and often without any public explanation. What happened before? Every major crisis is happening again, right now. And the numbers hidden inside the Fed's balance sheet are beginning to whisper the same warning they always whisper right before something breaks. Have you ever heard the story about the Federal Reserve losing $2.3 trillion? It sounds like the plot of a heist movie, right? A massive, unbelievable sum just gone. But the real story is far more complex, and honestly, much more unsettling. The truth isn't that the money vanished into thin air. It's that it slipped through the cracks of a financial system so vast and shadowy that no one, not even the Fed, can fully map it. And understanding this reveals a dangerous blind spot at the very heart of the global economy. For decades, we've been told a simple story about money. The Fed prints it, banks lend it, and the economy reacts. A nice, clean, linear process. But that's not how the world works anymore. Today, the global dollar system is a tangled web of onshore reserves, offshore dollar debts, synthetic credit, and complex collateral chains. It's a world of shadow banking, cross-border swaps, and financial instruments that behave nothing like the money in your wallet. This is where the so-called missing money comes in. The Fed's balance sheet is like a snapshot of its own direct interactions. It measures what it can see, what it can touch. But the global dollar system? It's an ocean, and the Fed's balance sheet is just a single lighthouse on the shore. So when $2.3 trillion appear unaccounted for, it's not a clerical error. It's a signal that immense financial flows are happening out in the deep, far beyond the lighthouse's beam. Think of it like this. The balance sheet starts showing imbalances that seem completely impossible if you believe the system is closed and controlled. But they make perfect sense once you realize the system is open, largely offshore, and partially invisible to regulators. This isn't just a theory. We saw it happen in real time. Starting in the early 2020s, the Fed began a process called quantitative tightening, or QT. The goal was simple: drain liquidity from the system to fight inflation. But what happened next baffled everyone. Instead of a uniform tightening, the financial world experienced bizarre contradictions. Some parts of the market were gasping for dollars, while others were awash in them. This contradiction was a huge clue. It meant liquidity wasn't just being removed. It was leaking, rerouting itself through hidden channels. And where were these channels? Everywhere. Private credit funds exploded, creating dollar liabilities completely outside of traditional banking. Hedge funds used massive, hidden leverage to make bets in the Treasury market. Foreign institutions took us government bonds and, through a kind of financial alchemy called collateral transformation, created synthetic dollars far from the eyes of American regulators. All the while, the Fed's own data started flashing warning signs. Reserve balances were falling faster than QT alone could explain. The usage of a key Fed facility, the reverse repo, collapsed at a speed that didn't match market patterns. These weren't random glitches. They were the footprints of the invisible system. They showed that global players were moving liquidity through pathways the Fed's traditional accounting was never designed to see. Now, let's talk about the secret ingredient that makes all of this possible: collateral, specifically as treasuries. In the global financial system, treasuries aren't just debt. They're the closest thing to pure, risk-free money. They are the oxygen of global funding. Banks, corporations, and governments around the world use them to secure loans, back trades, and prove their financial stability. So when the US Treasury unleashed a historic flood of new bonds between 2020 and 2024 to fund its deficits, it fundamentally rewired the plumbing of the system. The market was flooded with this pristine collateral. Everyone scrambled to hoard it, especially short-term treasury bills. They weren't just holding them as an investment. They were using them as the key to unlock private funding, creating liquidity in the shadows, completely outside the Fed's view. As this collateral moved, liquidity moved with it, pulled from one corner of the globe to another with incredible speed. Back at the Fed, this movement registered as a mismatch, an unexplained hole on the balance sheet. The money had simply flowed into markets the Fed doesn't fully monitor, into the hands of players who don't show up in domestic statistics, and into lending chains that create new dollar-like credit without ever touching the Federal Reserve. And this is the moment where the entire narrative flips. The $2.3 trillion discrepancy isn't a story about the Fed's failure. We imagine the Fed as the sun at the center of the financial solar system, with liquidity radiating outward from Washington. But the reality is the opposite. The Fed is more often reacting to gravity, not creating it. When the offshore dollar markets get tight, the Fed has to step in to provide relief. When global banks are desperate for dollars, the Fed activates swap lines to foreign central banks. When there's a shortage of good collateral, the Fed expands its repo facilities to calm markets. Every time it does this, its balance sheet records a movement that seems mysterious from the outside. But from the inside, it's clear. The Fed is adjusting to a system much, much larger and more powerful than itself. This is the mind-bending twist of modern finance. The Federal Reserve's balance sheet is not the map of the financial world. It's the seismograph. It doesn't show you the geography. It shows you the tremors. It records the earthquakes happening deep within the planet's core, in those hidden, offshore markets. The more you look, the more unsettling the picture becomes. If trillions of dollars can move through these channels without the Fed's direct oversight, if private networks can create dollar credit without increasing official reserves, then the global system has blind spots so large they could swallow entire economies. The Fed doesn't see these blind spots in real time. It sees them later, as distortions in its data, as strange signals in line items that were never meant to be a warning system. So, is the system broken? The real shock is that it isn't. It's functioning exactly as it has evolved to function, dispersed, opaque, and driven by incentives. It's a system capable of creating its own liquidity, a shadow money supply that rivals the official one. That missing $2.3 trillion? It's the clearest sign yet that we live in a two-tier dollar world. There's the visible world, the one we read about in headlines, which is regulated and accounted for. And then there's the hidden world, operating on momentum, trust, and collateral. As the stress in this hidden world grows, the strange signals on the Fed's balance sheet start to feel less like data and more like a warning. A warning that we, the public, were never supposed to understand. And that might be the most terrifying part of all. Ever wonder where trillions of dollars just disappear? The Federal Reserve's balance sheet is supposed to be the master ledger of the world's most powerful economy. But right now, there's a $2.3 trillion hole that standard economics just can't explain. To find it, we need to go deeper. We need to look past the headlines and into the hidden plumbing of the global financial system, the pipes and valves that most people never see. This isn't about conspiracy theories. This is about mechanics. It's about collateral reserves, offshore dollars, and the quiet power of global banks. Because in a system this big and this interconnected, money doesn't just vanish. It moves, it changes form, and it hides in places designed to be invisible. The Fed's balance sheet is like a seismograph, picking up tremors from a financial earthquake happening somewhere else. And that unexplained number isn't a mistake. It's the shadow of a machine operating just out of sight. Let's start with the simple, mind-bending fact. U.S. banks hold about $3.2 trillion in reserves at the Fed. That's the official, domestic money supply. But the global dollar system, the money used for international trade, loans, and finance outside the United States, is estimated to be several times larger. The Bank for International Settlements reports that non-U.S. banks hold over $13 trillion in U.S. dollar liabilities. Think about that. The world runs on dollars that the Fed doesn't print, held by banks the Fed doesn't regulate, funding deals the Fed doesn't even see. This is the core of the imbalance. And when that massive offshore system gets stressed, the symptoms show up back home, in places like the repo market or emergency swap lines. The Fed sees the fever, but it can't see the infection. The Fed's balance sheet is supposed to be straightforward. Assets on one side, like treasuries and mortgage-backed securities. Liabilities on the other, like bank reserves and cash. In theory, it should all balance. But in reality, the balance sheet is acting as a buffer between two completely different worlds. There's the onshore world, which the Fed controls with interest rates. And then there's the offshore world, which runs on something else entirely, collateral. The first warning signs appeared in mid-2022. The Fed started its quantitative tightening program, or QT, pulling over $1 trillion in reserves out of the banking system. At the same time, the U.S. Treasury was building up its own cash pile, pulling another $700 billion out of circulation. According to the textbooks, this massive liquidity drain should have caused a system-wide credit crunch, but that's not what happened. Instead, something bizarre occurred. A key Fed facility, the reverse repo, exploded to over $2.5 trillion. This was a signal that certain players had way too much cash and nowhere safe to put it. So, while the Fed was tightening, some parts of the system were drowning in liquidity, while others, especially offshore, were gasping for air. It was a contradiction, the first major clue that money wasn't flowing through the system like it was supposed to. To really understand what's going on, you have to talk about collateral. The entire global financial system is built on the foundation of U.S. Treasury bonds. They are treated as the ultimate safe asset, used to back up loans, derivatives, and complex financial trades all over the world. In 2023, the Treasury issued a flood of new debt, over $1.7 trillion worth. This debt didn't just sit there. It became the fuel for global credit creation. Here's how it works. A Treasury bond can be used as collateral for a loan. The person who receives that bond can then turn around and use it as collateral for another loan. This is called repledging or rehypothecation. The same single Treasury bond can be used over and over again, creating a chain of credit. It's like a financial magic trick. One estimate suggests that on average, a single treasury can be reused almost 3 times in global markets. This means that $1 trillion in new government debt can actually support $2 to $3 trillion in new funding. This is synthetic liquidity. It's real purchasing power, but it's created entirely outside the Fed's control. And this is where the imbalance really starts to take shape. While the Fed was doing QT and shrinking the amount of official money bank reserves, the financial system was busy creating its own money using these collateral chains. So, official liquidity went down, but collateral-based liquidity went up. The Fed's balance sheet only registers the first part of that equation, creating a massive blind spot. The $2.3 trillion hole isn't a hole at all. It's the ghost of all this private, collateral-based money creation that the official numbers just don't capture. Between 2022 and 2024, the Fed's numbers showed a massive liquidity drain. Over $1 trillion in reserves gone. Another $1.7 trillion drained from the reverse repo facility. $95 billion a month sucked out by Q2. If you just looked at those numbers, you'd expect a financial crisis. And yet, the markets held up surprisingly well. Why? Because the money didn't disappear. It just moved into the shadows. Hedge funds ramped up a complex trade known as the Treasury basis trade, effectively creating synthetic dollar liquidity. Money market funds, instead of lending to banks, poured cash into private credit and other unregulated channels. The liquidity didn't vanish. It just migrated from the Fed's visible balance sheet to the invisible balance sheets of hedge funds, foreign banks, and private lenders. Finally, let's look at the emergency plumbing, the swap lines. These are agreements where the Fed provides dollars to foreign central banks in times of crisis. They were used heavily in 2020, but even when there isn't a full-blown crisis, these lines get used because global banks are constantly short on dollars. They fund their massive dollar loan books using short-term swaps that have to be rolled over constantly. When stress rises, they scramble for dollars, and that pressure eventually ripples back to the U.S. The Fed sees this as a spike in swap line usage or a jump in the foreign repo facility, but again, the root cause is hidden offshore. So, this is how trillions in liquidity can seem to vanish from the Fed's view. It's not gone. Have you ever wondered where the money goes? I mean, trillions of dollars. Since 2022, the Federal Reserve has been on a mission, shrinking its massive balance sheet in a process called quantitative tightening, or Q2. The goal was to pull money out of the financial system to cool down inflation. On paper, they've removed about $2.3 trillion. But here's the mystery, the real-world impact on liquidity, the lifeblood of our economy, hasn't matched up. It feels like trillions have simply vanished. Where did it all go? Today, we're diving deep into the hidden plumbing of the global financial system to solve this mystery. This isn't just about accounting. It's about understanding the real forces that move markets, create wealth, and hide risks. The answer isn't that the money is missing. It's that it has moved into the shadows, into a complex network the Fed can't fully see or control. And what we find might just change how you see the world economy forever. Let's start with the key player, the Treasury General Account, or TGA. When the Treasury sells bonds to raise money, cash flows from commercial banks into the TGA. This acts like a giant vacuum, sucking reserves directly out of the banking system. Throughout 2023 and 2024, the Treasury kept this account topped up, often holding between $600 and $800 billion. That's a huge, direct drain on bank liquidity. So, reserves went down. But strangely, other parts of the financial system didn't shrink along with them. Why? Because while the Fed was draining the pool from one end, new streams of liquidity were flowing in from places it doesn't directly measure. We're talking about private repo markets, leverage used by hedge funds, and vast pools of foreign collateral. Most fascinatingly, synthetic dollar liabilities were being created offshore, essentially new dollars conjured up outside the US banking system. So, the liquidity wasn't missing. It was displaced. It migrated to parts of the system beyond the Fed's direct line of sight. To understand this better, let us rewind to the banking turmoil of early 2023. Remember when several regional banks were on the brink of collapse? The Fed opened two emergency windows. First, the discount window, where usage shot up to $153 billion, the highest it had been since the 2008 financial crisis. Then, they launched the Bank Term Funding Program, or BTF, which pumped out another $168 billion at its peak. This was a massive injection of cash aimed right at the heart of the problem regional banks struggling with losses on their bond portfolios. But here's the twist. That liquidity didn't just sit there as bank reserves. It was used immediately for all sorts of things, paying back depositors, shoring up collateral, and even meeting obligations overseas. When the BTF program expired in early 2024, the Fed turned off the tap, but the liquidity they had injected over the past year didn't neatly subtract from their balance sheet. It had already dissipated into the complex, interconnected web of global finance. Again, from the Fed's perspective, it looked like money that was once there had just disappeared. Now, let's add another piece to this puzzle: collateral scarcity. As the Fed continued QT, it let its holdings of Treasury bonds mature without replacing them. This meant the private market had to absorb a lot more government debt. But who was buying? Interestingly, foreign governments, like China, have been steadily reducing their holdings of US treasuries for years. So, private global investors had to step in and buy the difference. And what do these investors do with those treasuries? They don't just lock them in a vault. They use them as collateral in the repo market, a critical part of the financial plumbing where institutions lent each other overnight. A single treasury bond can be pledged and repledged multiple times in what's called a collateral chain. Each link in that chain effectively supports new funding, acting almost like new money creation. But this system is fragile. If anything spooks the market like rising interest rates or geopolitical stress, these chains can break. Institutions are forced to unwind their trades, pulling liquidity out of the system so fast it looks like it vanished. But the money wasn't destroyed. The collateral that backed it was simply withdrawn. The plot thickens when we look at how foreign institutions interact with the Fed. The Fed has a special tool called the FEMA repo facility. It allows foreign central banks to swap their US Treasury bonds for dollars, especially during times of stress. When they use this facility, they get cash, but the transaction doesn't show up as a clean increase in US bank reserves. It's a temporary swap that moves liquidity through a sort of foreign relay station. To an analyst just watching the main Fed balance sheet, the numbers look disjointed. One line item goes up, another goes down, and the net effect seems inconsistent. It's another case of so-called missing money that has simply taken a detour through the global system. But perhaps the biggest hidden actor in this drama is the silent giant of private credit. By 2024, the private credit market had swelled to over $1.7 trillion. These are funds that operate largely outside of traditional banking regulations. They borrow short-term cash and lend it out long-term, often funding their operations with dollars sourced from repo markets, foreign exchange swaps, or other forms of institutional leverage. These massive flows of money don't show up on the Fed's balance sheet, at least not directly. They only become visible when stress in the private credit world forces traditional banks or money market funds to react. As this market grew, it sucked up liquidity from other parts of the system, bypassing banks entirely. This is yet another reason why the Fed's QT didn't reduce liquidity in the way everyone expected. The liquidity wasn't missing. It had just migrated to a different ecosystem. The deepest, most fundamental reason for this whole discrepancy is structural. The global dollar system is not a closed loop controlled by the Federal Reserve. When the Fed shrinks its balance sheet, it doesn't automatically shrink the global supply of dollar-based credit. Offshore banks can still create new dollar deposits simply by lending. Repo markets can still spin up funding chains. Hedge funds can still create synthetic leverage using futures. The Fed might be contracting one layer of the system, but other layers are still expanding, morphing, and evolving on their own. That $2.3 trillion discrepancy we started with? It represents the gap between the part of the system the Fed controls and the vast, interconnected layers it can only influence from a distance. Even the structure of the Treasury market itself adds to this gap. In 2023 and 2024, we saw something unusual at Treasury auctions. Primary dealers, the big banks that are required to bid, were often forced to buy up 20 to 25% of the bonds on offer. That's way higher than normal, and it's a sign that demand from private and foreign buyers was strained. When these dealers absorb all that supply, they often have to finance the purchases through the repo market. This creates temporary pockets of liquidity that are invisible to the Fed's main indicators. And that $10 billion circulates through the system, creating the illusion of abundant liquidity even while the Fed is tightening. Then, when the dealer unwinds that trade, the liquidity seems to vanish overnight. Again, not missing, just shifted. Finally, we have to consider the Fed's own tools, particularly the Standing Repo Facility, or SURF. The SURF acts as a safety valve, putting a ceiling on repo rates by automatically injecting liquidity whenever the market gets too tight. Even if it's not used much, its mere existence changes behavior. Financial institutions know they can always get cash if they need it, which reduces their incentive to hoard reserves. This encourages more reliance on collateral-based funding rather than holding cash. So, the Fed's balance sheet might show stable reserve levels, but private players are operating as if liquidity is far more abundant than those numbers suggest. So, when you put all these pieces together, collateral being reused over and over, dollars being created offshore, swap line dynamics, massive Treasury issuance, private credit markets, and the subtle effects of the Fed's own facilities, the $2.3 trillion imbalance starts to make sense. It's not an error or an anomaly. It's the new reality of a global funding machine that has outgrown its central bank. The Fed's balance sheet is like a partial mirror. It reflects the shadows of the global dollar system, but it doesn't show the full body. When analysts look at it and see missing liquidity, they're really just seeing the limits of a measurement tool that was built for a simpler world. The forbidden flow of money beneath the balance sheet isn't a glitch in the system. It's a warning sign. The true risk isn't that the money is missing. The true risk is that our global financial system has become so complex and interconnected that no single institution, not even the Federal Reserve, can fully map it in real time. The mystery of the missing trillions tells us that we are navigating a new economic landscape, one where the old maps no longer apply. So, where did this $2.3 trillion go? The shocking truth isn't that the system lost it, or that someone hid it, or even that the Fed failed to track it. The most dangerous truth is that the global dollar machine has evolved. It's reached a point where massive amounts of liquidity can move, transform, and even disappear from the Fed's view without ever leaving the system. Think about that for a second. The very tools our policymakers use to monitor the health of the financial world have blind spots. Big ones. And this means the next crisis won't look like the last one. It won't be a repeat of 2008. The stress won't appear where everyone is looking. Instead, it will erupt at the seams, the invisible intersections between the parts of the system we can see and the vast, shadowy parts we can't. It will happen where hidden collateral chains crash into shrinking bank reserves, where financial obligations created in other countries' offshore dollar liabilities suddenly overwhelm the liquidity available back home. The Federal Reserve will find itself reacting to symptoms it can see, like a doctor treating a cough, while the real disease spreads silently, deep within the patient's body, in places the X-rays can't reach. This is the real warning buried deep within the financial data, beneath the balance sheets. A system can look perfectly healthy on the surface, running smoothly day to day, while its foundations are quietly eroding, one funding chain at a time. All the strange tremors we're seeing in the markets right now are not random, isolated events. They are all connected. Think about the rising demand for high-quality collateral like Treasury bonds, the tightness in dollar funding markets overseas, the sudden, unexplained spikes in the repo market, which is like the plumbing of the financial system, the strange fluctuations in accounts that banks hold for foreign central banks, the historic collapse of the Fed's reverse repo facility, where trillions of dollars just vanished back into the private market, and of course, the relentless, explosive growth of private credit. These aren't separate stories. They are all pieces of the same pattern, a pattern that has shown up before every single major liquidity crisis since the modern dollar system was born decades ago. Each of these signals points to one underlying truth. The global dollar network is tightening once again. Quietly, methodically, just like it always does right before something breaks. This warning isn't loud or dramatic. It's not a Hollywood movie plot. It's subtle, mathematical, and mechanical. You can see it in the little details if you know where to look. You see it when central banks quietly start using swap lines, emergency dollar faucets, even when the news headlines say the markets are calm. You see it when government bond auctions need more and more support from primary dealers, forcing them to take on more leverage in the shadows. You see it when banks start hoarding the best collateral, even when the Fed insists there are ample reserves in the system. And you see it in the way money market funds have pulled their cash out of the Fed's safe reverse repo facility, choosing instead to enter private lending channels. While that might sound boring, it increases the overall fragility of the entire system. Each of these movements is small on its own, but when you put them together, they form a clear shape. A shape that looks eerily similar to the early warning signs of 2007, the quiet tremors of 2019, and the hidden fractures that led to the market panic of 2020. If you stop listening to the official reassurances and start paying attention to the underlying incentives, that shape becomes unmistakable. A system this massive, this complex, doesn't fail suddenly. It fails gradually, and then all at once. The imbalance, the quiet tightening, that's the slow part. The consequences, that's the fast part. And the biggest consequence isn't necessarily another stock market crash or a specific bank failure. It is the moment we all realize that the world has become completely dependent on liquidity channels that no central bank, not even the Federal Reserve, can fully control. The Fed can stabilize the pieces of the puzzle it can see. It can bail out a bank or flood the domestic market with cash, but it cannot stabilize the entire shadow architecture that has grown up around the traditional banking system. The vast network of offshore dollar liabilities doesn't wait for policy guidance from Washington. The intricate chains of collateral that underpin trillions in transactions don't slow down just because the Fed holds a meeting. The private credit market doesn't stop tightening just because a policymaker warns of risks at a press conference. This new system doesn't react to speeches. It reacts to incentives, and the incentive driving everything today is simple. The world is starving. It's starving for safe collateral. It's starving for dollars. It's starving for the cheap and abundant leverage that fueled the global economy for over a decade. Now, it's being forced to operate in a world of tighter liquidity and higher interest rates. Something will eventually break. It always does when the system's shadow layers grow faster and become more important than its visible ones. So, the final warning whispered by the data is this: that missing $2.3 trillion isn't a mystery we need to solve. It's a message we need to understand. When liquidity moves into channels you can't see, you lose the ability to predict where and when stress will surface. When collateral, not cash, becomes the true currency of global finance, the whole system becomes vulnerable to shocks that might seem tiny on the surface, but are catastrophic underneath. And when the Federal Reserve becomes a responder, instead of an originator reacting to tremors from overseas, rather than setting the global financial weather, the illusion of control becomes the most dangerous illusion of all. We are entering a new phase. The next crisis won't be born in the heart of Wall Street. It will likely start in the outer circles of the dollar system in places like Tokyo, Frankfurt, Sao Paulo, or Singapore. Places where dollar-based debts have expanded far beyond America's borders and regulatory reach. And when those debts start to contract, the first sign of trouble will appear where it always does. Deep inside the Federal Reserve's own balance sheet, in the flows of money that move long before the headlines catch on. The warning, then, is simple. Follow the incentives. Follow the collateral. Follow the pressures that are quietly building beneath the surface. Because the balance sheet is speaking again, and its message is the same one it whispered before every crisis of the past half-century. Something is tightening, something is shifting, and once again, the world seems to be pretending not to see it.